Q. Identify the role of the Public Company Accounting Oversight Board, PCAB. The PCAB oversees audits of public companies. It establishes auditing standards, conducts inspections of registered public accounting firms, and enforces compliance to protect investors and ensure reliable financial reporting. T provides guidance on auditing internal controls. The PCAB issues standards that define procedures auditors must follow when evaluating internal control over financial reporting under SOX Section 404. IT enhances audit quality and independence. Through inspections and disciplinary authority, the PCAB promotes accountability among audit firms and improves confidence in the auditing process. R. Differentiate between top-down and bottom-up auditing approaches. The top-down, risk-based approach begins with financial statements. Auditors identify significant accounts and disclosures, assess risks of material misstatement, and then evaluate relevant entity-level and process-level controls. The bottom-up approach focuses on individual transactions. It tests detailed controls at the transaction level without first assessing overall risk exposure, potentially resulting in excessive or inefficient testing. Risk-based auditing improves efficiency. By concentrating on areas with higher materiality and risk, the top-down approach ensures effective resource allocation and stronger linkage between risks and controls. S. Identify the PCAB preferred approach to auditing internal controls. The PCAB endorses the top-down, risk-based approach. This method emphasizes identifying significant accounts, relevant assertions, and high-risk areas before testing specific controls. T prioritizes entity-level controls. Auditors first evaluate the control environment, management oversight, and risk assessment processes, which influence the effectiveness of lower-level controls. The approach enhances audit effectiveness and efficiency. By focusing on material risks and key controls, auditors avoid unnecessary procedures and provide more meaningful assurance regarding internal control reliability. T. Identify and describe major internal control provisions of the Foreign Corrupt Practices Act, FCPA. The FCPA prohibits bribery of foreign officials. Companies are forbidden from offering payments or benefits to influence foreign government officials in obtaining or retaining business. T requires accurate record-keeping and internal accounting controls. Organizations must maintain detailed books and records that accurately reflect transactions and implement controls to prevent and detect improper payments. Compliance strengthens ethical governance globally. By mandating transparency and accountability in international operations, the FCPA promotes integrity, reduces corruption risk, and enhances investor confidence. P. Describe the major internal control provisions of the Sarbanes-Oxley Act, SOX. Section 302 requires executive certification of financial reports. The CEO and CFO must certify that financial statements are accurate and that internal controls over financial reporting, ICFR, are effective. This increases executive accountability and reinforces ethical financial reporting. Section 404 mandates management assessment of ICFR. Management must annually evaluate and report on the effectiveness of internal controls, and external auditors must attest to management's assessment for public companies, significantly strengthening governance and transparency. SOX enhances audit committee independence and oversight. Public companies must maintain independent audit committees responsible for overseeing financial reporting, internal controls, and external auditors, reducing conflicts of interest and improving investor confidence. T. Identify and describe major internal control provisions of the Foreign Corrupt Practices Act, FCPA. The FCPA prohibits bribery of foreign officials. U.S. companies and certain foreign issuers may not offer payments or benefits to foreign officials to obtain or retain business, reinforcing ethical international conduct. T mandates accurate books and records. Companies must maintain detailed, truthful accounting records that reflect transactions fairly and transparently. Internal accounting control requirements are central. Organizations must implement controls that provide reasonable assurance that transactions are properly authorized and recorded, reducing corruption risk and strengthening global governance practices. U. Identify and describe the 5 major components of the COSO Internal Control Integrated Framework. Control environment establishes the foundation for all internal controls. It reflects management's integrity, ethical values, governance oversight, organizational structure, and commitment to competence. A strong tone at the top supports accountability and influences employee behavior, forming the basis for effective risk management and reliable reporting. Risk assessment involves identifying and analyzing risks. Organizations must define objectives, identify internal and external risks, assess fraud risk, and evaluate changes that may affect controls. This component ensures that controls are aligned with evolving operational, financial, and compliance risks. Control activities, information and communication, and monitoring ensure controls function effectively. Control activities include policies, procedures, authorizations, and reconciliations. Information and communication systems provide relevant, timely data. Monitoring includes ongoing evaluations and separate assessments to verify that controls remain effective over time. 5. Assess the level of internal control risk and recommend mitigation strategies. Internal control risk reflects the likelihood that controls fail to prevent or detect material misstatements. Assessment begins by identifying high-risk areas such as complex transactions, significant estimates, decentralized operations, or weak segregation of duties. Risk evaluation considers both design and operating effectiveness. Poorly designed controls or inconsistent application increase risk levels. Organizations analyze control documentation, prior audit findings, and changes in systems or personnel. Mitigation strategies strengthen governance and procedures. Recommendations may include improving segregation of duties, enhancing authorization controls, implementing automated systems, increasing monitoring activities, conducting employee training, and performing periodic internal audits to reduce residual risk. W. Demonstrate understanding of external auditor responsibilities and audit opinions. External auditors provide independent assurance on financial statements. Their responsibility is to express an opinion on whether statements are presented fairly in accordance with the applicable financial reporting framework, while maintaining professional skepticism and independence. Auditors assess internal controls and gather sufficient appropriate evidence. In public companies, they also evaluate internal control over financial reporting. Audit procedures include risk assessment, substantive testing, and evaluation of accounting policies and estimates. There are 4 primary audit opinions. An unqualified, clean opinion indicates fairness. A qualified opinion identifies specific issues. An adverse opinion signals material misstatement. A disclaimer indicates insufficient evidence to form an opinion. X. Identify and explain methods for testing internal controls. Inquiry involves asking personnel about control procedures. While useful for understanding processes, inquiry alone does not provide strong evidence and must be corroborated with other procedures. Observation allows auditors to watch control procedures being performed. This method confirms whether procedures such as inventory counts or reconciliations occur as described, but only at a specific point in time. Inspection and reperformance provide stronger evidence. Inspection examines documents and records for authorization and accuracy. Reperformance involves independently executing control procedures, offering direct evidence of operating effectiveness and reliability. Y. Explain how to remediate internal control deficiencies. Remediation begins with identifying root causes. Management must determine whether deficiencies arise from poor design, inadequate training, lack of supervision, or intentional override, ensuring corrective actions address underlying issues. Corrective actions improve both design and operation. Organizations may revise policies, strengthen segregation of duties, enhance system controls, provide employee training, or increase monitoring to ensure controls operate effectively. Ongoing monitoring verifies remediation effectiveness. After implementing corrective measures, management performs follow-up testing and documentation. For material weaknesses, timely disclosure and auditor involvement may be required to restore stakeholder confidence.